public businesses. You can say verse or compare, or compare, or we contrast. Comparing and contrasting are identical and polar opposite all at the same time. Public and private, what? Businesses. Josh, you taking?
Yep, I'm taking, yeah.
So, our design is to consider that there are different business models, different business entities, different business structures. These are designed as business models or business structures or a business entity. Now, this gets into entrepreneurialism and enterprising, so for those of you that are interested in owning your own business, this is where you land. If you get good with this, you can own your own business. And those that own their own business and aren't very good with this, then they generally lose the business. Doesn't go very well. So you've got to be good with corporate enterprising and structure and accounting and finance, and then you can own your own business, you do it well, you provide a profit to your family and a service to the public. So businesses are set up to be either operating in the private sector or in the public arena. The private sector or the public arena. In either case, we would simply call them the marketplace. Now, the marketplace of life is where people go and do business. We buy groceries, we buy insurance, we have our car fixed, we buy gas, we buy Starbucks, we buy Dunkin' Donuts, we watch TV, we subscribe to this, we pay for this. All the stuff that we do that is contained within our life. We go to college, and college business, and things we do here at North Greenville, all of that occurs in the marketplace of life or in the marketplace itself. And so the businesses that we work with and contract with and work for and subcontract for are either public or private businesses. And they have different financial models, they have different operating goals and strategies, they are structured differently, they have different reporting structures, they have different hierarchy. The hierarchy would be the same thing as the organizational structure, people at the top all the way down. Depending upon if it's public or private, there are different hierarchies within the organizations. Probably the most predominant business difference between the two is going to be the financial model. Private sector businesses are always, and almost always, but not necessarily always, for-profit. Public sector businesses, financial models, are what you would call nonprofit and government owned and operated and driven. Now, in the private sector, we do have nonprofits. We do have the nonprofits. North Greenville University is a nonprofit, privately organized private sector business. The Travelers Rest YMCA is a nonprofit private organization. Upward Sports is a nonprofit private organization operating in the private sector. Now, most of us are quite familiar with the for-profits, any manufacturer like Adidas, Nike, information sharing organizations like ESPN, or any professional franchise like the Braves, the Hawks, it's Atlanta, my favorite, the Indians, Browns, any franchise, 99.99% of them, there's only a couple in the whole world that aren't, are set up and designed and owned and operated as a for-profit, private sector business entity. So the financial models for these for-profits make profit. Financial models for these provide a service, while still generating enough money where you break even or you make a profit. Can a non-profit business in the private sector make a profit? Absolutely. The difference is what they do with it afterwards. So your Upward Sports and your YMCAs and NGU are desperately desiring to make a profit. Just like the Braves, the Hawks, the Indians, and the Browns that are designed as for-profit businesses. The only difference there is that the government requires nonprofits to reinvest back in the business. Nonprofits like the Travelers Rest YMCA, they still must run a strong financial model. They still must make money to support the operations, pay the people, provide for new equipment, do the things they do. And on the balance sheet, if they are generating a profit each quarter, each semi-quarter, semi-annual, or annually, those are required to be automatically invested back into the business itself. They're designed as service entities, and they're not permitted to dispense profits. A for-profit company wants to make profits so it can share the profit with the owners. So in this instance, all of the profit, if there is any, not every for-profit business makes profit, all of the profit not reinvested, instead is shared. Well, I like that. I can buy stock, be an owner of a company, the company does well, they pay me a dividend, my stock goes up. I get to share in the financial success of the organization. Which consequently, because of this structure, it allows you and I to eventually become owners. We can buy into a for-profit business. We can start our own for-profit business. I can merge into or merge with a for-profit business. So you and I, as individuals in the marketplace, any American citizen has the right to buy into an American C corporation, for example. Buy the common stock. If the stock is available and they're selling it and you have enough capital to buy in, you can buy the stock either privately or publicly. It's publicly traded on the open market. So you and I have the chance to become the privateers. So when you and I are the owners, this is where we are the privateers. And I've owned several sport businesses. I've owned bowling centers, I've owned pro shops, I've owned consulting businesses, I've owned 2 different health clubs and wellness centers, and I don't own them outright, you share them with others. I've had ownership in accounting business, so non-sport businesses. I owned a baseball card business at one time. So we have the opportunity and the privilege as a private citizen to be a privateer, to become an owner of a for-profit company. And if the company makes profit at the end of the years, my stock value goes up, they pay me a dividend check. I get to share in the benefits and the rewards of the company doing well. The nonprofits on the private side, nobody owns the YMCA's, nobody owns the Upward Sports, nobody owns NGU. It's established as a nonprofit, it's oversaw by a board of directors or a board of elders, like a church. Nobody owns a church. So a church would be another good example. The church that you go to is set up as a nonprofit. Nobody owns it. The assets are allocated to a certain 501c3 organization, maybe a smaller group or maybe the larger denomination. So they control the assets or they have right to the assets. But nobody officially owns a YMCA or Upward Sports. No individual. Not in the sense that there's ownership in stock and shared responsibility. And therefore, when they make money, the money's not distributed to the shareholders. So there is no financial benefit to being involved in a nonprofit. The reasons why we get involved in nonprofits are not the same reasons why we get involved in for-profits. I get involved in for-profits because I can make money at it. We get involved in nonprofits because we want to serve a community. So I work with my church because I'm serving the kingdom of God. I own stock in for-profit companies because that's where I see the payoff. That's the financial differences there. We're still on the private side. We're staying with the private. All private companies in the private side, whether you are a for-profit or a non-profit, they're all established as a corporation. Hence, what you might see is the phrase or the word Inc. Incorporated. So we establish a non-profit corporation, we establish a for-profit corporation, and in either case, they are established as a corporation, and that happens usually with what's called the Secretary of State. Secretary of State, in this case it'd be South Carolina. So if you ever want to apply for it and establish a nonprofit or for-profit, you get a lawyer, you hire basically a business attorney, and they create the documents for you. You pay them sometimes a lot of money, and they create a C corporation for you to sell stock, or they create a nonprofit foundation for you, or a for-profit. There's all these regulations you have to go through in the creation of one. But in the end, you would send the application and documents into the Secretary of State, and your state government would then award you with the Articles of Incorporation, and you're either incorporated as a for-profit company or you're incorporated as a nonprofit company. In either case, you're then liable to begin reporting activities to the state government and the IRS. And so they issue you, basically the business gets a Social Security number, it's called an EIN number. And just like you have a personal Social Security number, the business gets an EIN number. And that EIN number is basically the business Social Security number. So when you do business, in the banks and all the stuff, you have to provide that Social Security number just like you do personally anywhere else in society. You have to file tax returns for the business, you put the business EIN number on it. When you open bank accounts, when you borrow money, when you sell stock, when you do all those kind of things, to legitimize the business, you have to have an EIN number. Just like you have a personal Social Security number. So these companies are established for-profit, non-profit, and then they have to go out and do their business, and they all have to figure out how to make money. The truth is the non-profits actually have to work a lot harder to make money, because sometimes it's not as easy than it is a for-profit. Yes, you have a question?
Yeah, so the EINs are they, you said they're just for private, right? Or they're not for public as well?
Yeah, not for public, yeah.
Okay, just private.
Yeah, it's a good question. Yep. privateering. The financial model is the biggest difference. How they raise money, they sell stock initially, capital investments in nonprofits. How they raise money going into the business community, these folks all sell stuff, whether you sell memberships at the YMCA, or you sell balls, bat, and shoes at Walmart, or you sell tickets to a football game. We all sell product, we all do sponsorship, we all raise money through events, we all have services. So whether you're a for-profit or a nonprofit, we largely do the same things. So there are actually for-profit health clubs that compete with nonprofit YMCAs. There are for-profit gymnasiums that compete with the nonprofit medical fitness centers. So they operate in the same industry. Some are for-profit, some are nonprofit. Some are more service-minded, some are more profit-minded. In either case, we have, for you and I, there's the opportunity to go to work in both segments of the private sector. You can go to work for a nonprofit, or you can go to work for a for-profit. There are both excellent sport management jobs in both divisions of the private sector. We have lots of students that graduate that go on and work for for-profit entities. We also have lots of students that graduate and go on and work for successful nonprofit entities that are all private in the sports sector, in the private sector. Sticking with the financial model, I'm gonna have to erase a little bit and keep moving. I'm gonna erase public side, and then I'll draw that again at the end. The financial model, another one of the differences over here is that they can go to the bank and borrow money. Take out a loan, a commercial loan, to build a health club or buy land and to expand. And if you have a business plan, if you have assets, and so the businesses, both the nonprofit and the for-profit, have an ability to go and use the commercial banks. So commercial bank borrowing. Is very convenient. Now, generally, for-profits have more success with commercial banks than nonprofits. Why? Because they usually have more assets. So when a bank loans you money, they want to know they're going to get repaid, and they want collateral. So a for-profit business usually has more assets, that's collateral. They usually have either reserves or resources to pay back, that is repayment. It's a little bit harder for nonprofits, although nonprofits can go borrow money when they need to expand, when they need to buy new equipment, when they do whatever. It's less likely. Churches can go borrow money to build a new building, so they raise a certain amount of money through a campaign, and then they go to the bank and they say, hey, we raised $1 million, will you loan me 3 more? Yes, because my business plan requires $4 million to do the extension. You brought in the first $1 million, they loan you the last 3, and then you spend 25 years paying them back that $3 million, whatever that amortization schedule is. That's accounting. Amortization is repayment. P&I, principal plus interest. So nonprofits can borrow money. It's a little bit harder. They tend to be harder on churches and ministries and all kinds of nonprofits like Shriners and different organizations. So what happens is all those organizations have to be subsidized by, there's a great word, we've used that all the time, subsidized by other individuals. So when a church wants to add an addition on, when a YMCA, they have a campaign, and they ask all the church members or all the YMCA members, will they contribute to the campaign to raise enough money to go ahead and get the project started. When a for-profit wants to go to the bank and borrow money, they don't go to all of their constituents and raise money through campaigns. For-profits don't do that. For-profits look at their resources and look at their budgets and balance sheets and say, well, can we afford to pay it back over 30 years? How much money do we have in reserves to allocate toward whatever the new expansion is, a new facility, new site, expansion, new equipment, whatever the additional spending is, they want to borrow money. So for-profits, particularly those that are run well, that have lots of resources, for-profits can actually take advantage of the commercial banking sector and do it very well. And the truth is, if you get to be really good financially, and you get some good banking relationships, it's really quite easy to go in the marketplace and do business with commercial banks, and then you can move your business forward, and when I say forward, I also mean growing it both horizontally and laterally at the same time. So the commercial banking sector, they like to be paid back, they like to be paid interest, that's how they make their money, and the for-profits can generally do that better than the nonprofits. Not that the nonprofits can't, it's just a different financial model for the nonprofits. Churches don't have the extensive resources, churches generate money, YMCA's generate money only based on how people are doing. If churches receive givings, a nonprofit, YMCA receives membership. Upward Sports, for example, they receive money only when they're selling their services, their kids programs. So a bank may look at them with more scrutiny and say, well, your resources are more considerate of how things are in the marketplace. If the marketplace is down, nonprofits have a harder time borrowing money. If the marketplace is up, everybody can borrow money. It's just that easy. So right now, the stock market's up, we're in a bubble, and people can borrow money and buy a house or refinance a house fairly easily. Rates are low, and banks are looking to do deals. So when the markets are way up and everybody's retirements are way up and there's extra income, then the banks are more easy to work with. And when the markets go down and people get cash conscious and they start pinching pennies, then the banking system, it's a lot harder to work with. But the for-profits, if it's a good company, which all of these are that I identified, big companies, but not just that, but good companies, they usually have good, strong reserves, they usually have good, strong resources, and they've got a track record, they've got a history of being able to do business and pay off their indebtedness. So one of the advantages is that as a for-profit continues to advance year after year, they show that they can repay debt, because they've actually borrowed and repaid a time or two before, so they have a history of being a good creditor, and that's important. Now, nonprofits can also build that history and build that what's called historicity, their history of borrowing and repaying. So in that regards, whether it's a for-profit or nonprofit, we're not saying that borrowing money is bad at all. In fact, a lot of times how to establish a business and advance a business requires the support of another. So the commercial banking center is the subsidizing of a new business. Well, how do we subsidize athletics? Student activity fees. Remember, we've talked about this the last 3 months. Most college athletics has to be subsidized year by year, year over year. Most nonprofits, if they're looking to advance and grow, they have to be subsidized. It's the bank. So when you borrow money from a bank, you're basically having someone else underwrite the bill, and then you're paying them back over the course of time. And so that is how they all expand and grow and add new product, they buy new equipment. Obviously, we're putting money in reserves, we're saving, and so organizations, both of these guys, will save money when they can. When they're having good years, they'll put money back into reserves and savings to help against that. The truth is, the less you borrow, the less you owe, because you're being charged on the repayment. So now let's park there for a minute, so make sure we understand that. If anybody has ever borrowed money, or you will borrow money at some point in time, you'll have to pay back the principal with interest. In accounting class, it's P&I, principal and interest. Now, the principal is the actual amount you borrow, $20,000, $120,000, 1.2 million, 100, whatever that number is. And the interest has a rate, an interest rate, 2, 3, 4, 5, 6, 7, 8, 9% attached onto it, and then that's amortized over X number of years, so you're paying the principal back with a small amount of interest each month when you make a mortgage payment, and that's where the bank is making their money. Their profit margin is built into the interest rate. Their growth and advancement as a bank comes when they lend you money with interest attached, and then you repay it with interest. So they like it when you make payments because they're collecting their interest. They like it when you borrow and are a good steward of making payments on your car and your house and your student loans or whatever, because they're collecting on the interest. And so they actually only make money when they loan and when they're collecting the interest. And so understand that banks are in the business of doing business, they'll make money off of you. And so if you can avoid borrowing money from banks, or borrowing from credit cards, or borrowing from your brother, your friend, your sister, your cousin, your whoever, and paying back on interest, you're gonna be better off. So we must, as business entrepreneurs, constantly be reserving money into savings so that I don't have to defer to borrowing through commercial banking or commercial lending, only when absolutely necessary. Big projects, when you gotta redo a roof on a house or a building, usually people have to borrow for that. When you got to build a new building or add an extension or add a wing, I mean, some churches can raise money, some nonprofits can raise money, for-profits are setting it aside, and then they go and they borrow whatever they needed, depending upon if it's a really, really big project or not. North Greenville paid off its interest-bearing debt a number of years ago under Dr. Epting. We've been a debt-free institution for a long time, so none of the tuition payments that you make go toward debt service. Most other institutions in this country are paying on debt service, so unfortunately their tuition payments are higher because part of their tuition payment goes toward debt service. So that's one of the advantages of being in North Greenville, is because we don't have any short or long-term interest-bearing debt, we're not passing that down to you, and you're not paying the upcharge on that. So what you're paying for is the educational experience, and not somebody else's previous livings or borrowings, which sometimes can be unfortunate. Just look at my notes, make sure I don't miss anything. One last thing about commercial banking and borrowing, and then we'll move on. Either for-profits or nonprofits to qualify to borrow from commercial banks, must be a business in good standing. Businesses have credit ratings, just like individuals have credit ratings. We can pull the credit on an individual to see if you're good with, I could actually pull the credit on every one of you, and I could tell you whether or not the world believes you're good with business. I could look at your credit report, and I'm pretty good at reading them, and I can tell you everything it says, and does the world believe, based on the credit reporting system, you are a good steward of your money or not? So I don't have to go very far. I can look at your checking account over the past 1 or 2 or 3 years. I can look to see if you keep consistent records, and I can pull your credit, and that tells me all I need to know about you. So I don't ever have to hear from you, because what happens is people try to convince you, and when they try to convince you, they generally like to lie to you. So when people work real hard to convince you of something, they're actually probably not always being very honest with you. So how do you verify? Pull credit reports on people. How do you verify businesses are good stewards? You pull the credit reports. And are the businesses paying their bills on time? Do they pay off their debts on time? Are they not oversubscribed with obligations and indebtedness? All of that can be determined in the credit ratings of the business, which means the business can be classified or qualified in good standing, they can be classified or qualified in average standing, or even poor standing, and there's all these different intermediate points as well. Just like you have a credit report where you can, you can come in between 600 and 650, or 660 and 720, or 720 and above is very good credit, and anything over 800 is immaculate, that kind of thing. So the business community in the marketplace has the same standards that apply to for-profit and nonprofit businesses. And so banks, in order to know when you walk in, you can have statements and all kinds of things that show that the business has money, and the business has this, and the business doing that. But one of the ways they verify and qualify you is to see if you're in good standing, is to pull your credit report using your business's social security number. If that's the case, then you qualify to be a bank borrower initially. There's other things that go into that. But you qualify because you're in good standing. Just like you as an individual. If you were to go to a bank today individually and you wanted to borrow money to buy a car or a set of golf clubs because you want to go down to Masters and practice, if you wanted to buy a boat or a motorcycle or a home, the bank would pull your credit. They would see how much indebted you are, and are you paying consistently, are you late on payments? They would also look at your income statement to see if your income actually allows you to make a new obligated repayment. And so they do the same here. Do the revenues of the business allow for them to repay an extra couple of $1 million they're borrowing, or a couple $100,000 they're borrowing, or whatever? So all of that is predicated, and is the business in good standing? That's the credit report, and then do they have the resources to be able to pay back? Now, just because you're in a business of good standing doesn't mean you're gonna be able to repay back a $1 million loan. If your business is in good standing, but all you're ever doing is breaking even, that means you can't afford any more payments. So to be saddled with another $3,000 payment every month, or $300, or $13,000, whatever that number is. I remember at one point in time I borrowed $2.2 million to buy a $4 million tract of land, and the repayment on that $2.2 million loan was $18,000 a month. Now we had the assets, but also the revenue to support that. So we were able to show that yes, we can handle another $18,000 a month in payments, and it won't sink the business or put a tremendous amount of strain on us. So in that situation, they're not only looking at your credit report, which is the first solid qualifier to go and borrow money from a bank, but they're also gonna look at your income statement. I'm sure you talked about that in accounting 1 or 2. The income statement is the determinant. It shows you, it's the determining factor, how the business has done historically, last month, month before, year over year, last year, year before, and are you capable of making the payments that the bank or the lender is requiring so that they get paid back. Remember, the commercial banking business is in the business of making money off of you. So if you really don't want to waste money, don't go to them. But if you need their money to expand your business or add on to your church or grow your ministry or advance your team, and you can show that you're in good standing and you can show that you can make the repayments, well then commercial borrowing is a good vehicle. I have a cousin, David, who owns the Briggs Company in Lexington, South Carolina. He's built, Lexington, Kentucky. He's built over 1,000 homes. What did he tell me the other day? Over 5,000 apartments and at least 2 or 3 dozen commercial buildings. He's building his first bridge right now. And he borrows from the banks every month as he's doing deals. And he's constantly got money coming in that pays it off and going out, and he's borrowing. And so he has a great standing with several banks, and he's doing deals constantly, and he's making money then from all that. But it's he spends more time managing the money than he actually does doing the actual building now. His construction company, he's got supervisors that kind of manage the business for him, and he does the financial. He's worth, I don't know, 10, 15 million. I just went into his $2 million home the other day. He's got a half basketball court. He's got the big UK logo right on the floor in his house. So my kids were down there playing basketball, and it was kind of cool.
That's amazing.
I don't know what it's like to have 12 bathrooms in a house. It's like, I've got 4 in mine, 12. Anyways, yeah. We good money people in the Briggs family. Okay, let me see if I want to move on and do some public stuff because we're doing a comparison. And so I need to probably erase some of that and then do some of the public venturing. So we started by comparing and contrasting private and public businesses. Public businesses are government-owned, government-operated, government-funded, government-subsidized, government-controlled. Everything government. They're always a service business, always. They're designed with the public in mind. So when we say the word service, it's designed to offer something in the marketplace to the public. It's designed to do so not in a for-profit, and a lot of people consider for-profit to be expensive. That's not the case. But the services are offered to the public in a convenient and a reasonably priced or what you might call affordable manner. You can join the health club that charges $120 a month, or you can go down to the rec center that charges $12 a month. So depending upon the socioeconomic status that you live in, depending upon the financial capabilities that you operate within, that you come through, the job you have, largely depends on where you shop. Some of you shop at Whole Foods, okay, that's expensive. Some of you shop at Walmart, that's less expensive. Some of you go to Publix, the meat's a little more expensive because it's good quality. Or maybe you buy from a private butcher, high-end good quality. But maybe some of you go to, what's the German grocery store on Wade Hampton? Aldi's. Very low cost. Still good products, but a low cost because of the business model, the way they've set up the operational model. So my wife likes to go between the two. She does certain things at Aldi's, certain things at Publix, and a couple of things at Walmart. And so that's a savvy buyer right there, knows how to pick and choose. Service businesses that are government funded, owned, and operated are designed to serve the public. They're reasonably priced and affordable, and they're designed to reach the social middle and the social lower classes. Lower. Of society. Now, do these products serve the upper? Yes, they do. But are they meant for the upper? No, not necessarily. So the inexpensiveness of the local, so you go in town here, and we have football leagues, the Pee Wee football leagues, and the baseball leagues, and the rec department provides the soccer, and the rec department provides tennis, and and those are very inexpensive, because most people in the public can't afford the expensive models. So they're very inexpensive options. Now, when the YMCA's do youth sports, they're also very inexpensive because they're a nonprofit. So if you were to do price analysis, you may find that the offerings from YMCA's in regards to sport programs and the offerings from the local rec department, the Greenville County Recreation Department, they're probably going to be vastly similar. They run football leagues and basketball leagues and volleyball leagues and soccer leagues, and they're designed to serve kids and people in the community. And so the nonprofits on the public side and the private side, and the government-funded, government-subsidized run services through rec departments and other examples of that are fairly similar in price. They serve fairly similar people groups. You just have one that's government-driven and one that's private. So we have lots of our graduates that go work for YMCA's and YWCA's. They're on this side. We also have lots of graduates that go work for rec departments. Here in the Greenville rec, we've got at least 3 graduates that work full-time there. Over in Spartanburg rec, I can name you 4 or 5 that work there. And I can, if I went through my database, I could pull out probably a dozen others that work in rec departments around the southeastern United States that all come out of our program. Those are great jobs to go and become program directors and program administrators and sport directors and youth sport directors and fitness directors. And all of those rec departments and all of those county community rec departments and county community centers and county community facilities. So some of them are like the Bilo Center, the convocation centers that hold all these events, and they're bringing in sport constantly, and they change over, and boy, it's a lot of fun. That's a great job, and those are opportunities you want to look at. You can intern at those places when you become a senior, and then you can go to work for them. They're run by government entities. Most of these are going to be local government entities, so don't confuse that with the federal government. They're going to be local. So who runs the Greenville Rec Department? The Greenville County. Well, who's that made up? It's got a mayor in the Greenville City, we got county commissioners, we got county board of educators, they got a county coroner, they got a county water person, they got county everything. So those are elected officials, and the county commissioners oversee the budget that goes to the rec department. The rec department has an administrator and then a whole bunch of people down below, but they are county employees, or if it's the city of Greenville, so depending upon how big the city is, so it's obviously like the city of Chicago, it's got one big Chicago rec department and probably dozens of smaller metropolitan areas that serve the rural communities around Chicago or the outskirts of the metropolitan area. Here in Greenville, we have one rec department that has a few branches, and then Spartanburg has a few, and even some of the independent groups like Greer might have its own Greer rec. some of the local annexed communities might have their own, for example. Probably the biggest, now, one of the biggest differences here, the financial model, these guys are always nonprofit. Because they're service-minded, they're subsidized by the government, they're not allowed to generate profits, so they actually set their what's called their zero-based budgeting, their bottom lines, so that they break even. Again, if they cash flow positive a little bit, it goes right back into the business right away. And they don't have shareholders, they don't have owners that make ownership decisions like we do on this side. They don't have boards of directors or board of elders or a board of commissioners, or they do have boards that oversee, but they don't have the private owners that can sell. These businesses can't be sold to private individuals. You can't buy into them. They exist to serve the public in a public arena, and so very service-minded. Those are great jobs. You can get your feet wet and get a lot of experience working for them. And when they have financial issues, they always go to the government. So they have, in some regards, deep pockets, because they don't have to borrow money and manage their financial position in the same way as these guys. When these guys start to struggle financially, they've got to solve the problems themselves. When these guys have financial needs or financial issues or financial matters, they can go back to the government entities who originally started them and oversee them, and they can ask for more money. They can ask for more opportunities. So the Greenville Rec Department, if they are over budget, they can always go back to the local government and ask for more money. That doesn't mean they're automatically granted it, but it's a different operational model than on this side. And so the bigger you get, like I told you the other day, Clemson University is a government-run institution. It's run by the state. It's operated by the state. The athletic department's responsible to the state. And so when Clemson or USC or USC Upstate or any of those public institutions need resources, they obviously do their own private fundraising and they do other things, but if they get into difficult times, South Carolina State, they get into difficult times, they go to the government and they say, hey, we need money to keep going. Things aren't going well. And the state government either decides to keep funding them to keep them afloat, or to make some major decisions to bring major changes. They can't generate profit to be dispensed to privateers. They do. They've chosen not to. And those are your biggest differences. If you want to be an owner, for profit, private company. You can be a president of a YMCA, what they call YMCA director. You can be the president of Upward Sports. You can be the president of NGU or any other private institution. You could be the senior pastor, executive pastor of a church. So you can be the head leader of a nonprofit, and you do have financial responsibilities, but there's no financial kickbacks in that you can't own stock, you don't get the dividends, the growth in the stock, there's not the financial upwardness. You still make good salaries. The people that lead these organizations make very good wages, great jobs, great opportunities, and if that suffices you and you're content now, we just read that in 1 Timothy 6, if you can be content with whatever God gives you, which I actually pledge, if you can be content in that, it doesn't matter whether you have ownership in for-profits or not. I just happen to enjoy it. A lot of people do, but a lot of people don't enjoy the private sector and the for-profit model. So what are the biggest differences? The financial model, because they're both in the marketplace. Privately held, privately organized, and privately operated. Publicly held by government officials and government agencies and governments. So nobody owns Clemson University's athletics. Nobody owns the Travelers Rest YMCA. Nobody owns whatever the name of the park is that has the skate park and the swimming hole and the tennis, the public tennis, the public golf course. Nobody owns that. Now, privately owned golf courses, one next door, Cherokee Valley. Who owns it? there's an ownership group or an ownership person or an ownership company that owns the land and the building, the assets and the golf course. Do you know who that is, Miller?
The owners,
Yeah,
Matt Jennings.
yeah, so I think the family, they got Matt involved. I don't know if he's the sole owner or there's some shared responsibility, because I've met the uncle or the dad or somebody that was also involved. But, so that is a private entity. I'm gonna assume they're for-profit. They're building houses and selling houses, and they're building all kinds of stuff, and they wanna sell rounds, and they wanna sell lessons, and they wanna sell homes, and they want you there, because that's their financial model. And they make money when they sell land and they build houses, and you come in and you eat from them, and you play rounds, lots of rounds, you play in their tournaments. And so that would be a great example of a private. But there are public links, public golf courses. Miller, what's one of the public ones here in Greenville?
Greer Country Club.
Okay,
Got bought out by the city.
yeah, so in that instance, it was private, it's now public, it's open to the public, you go play, you pay a fee, and that fee is designed just to keep it operating so it's available to the public. I would assume public golf courses, the charge rates, the rates are a little bit lower than the private courses. If I try to go play at the Cliffs, first of all, if you just walk up there and you say you wanna play, they're gonna tell you to turn around and go. Because the only way any of you can play at the Cliffs is you either are an owner there or you get invited by an owner. Is that not right, Miller? So similar to Augusta National. You just can't walk in and pay a fee and want to play at Augusta National. You're either invited by a member, and there's, at the Augusta National, there's this long list of scrutiny, or at the Cliffs, there are ramifications, consequences. There are qualifiers. But you can go to any public course that's run by a public entity, a government, and play golf. Or you can pay to swim at the public swimming hole. Or you can pay to use the tennis courts. Or when we had a birthday party out of the park, we rented the shelter. Well, that's all controlled by Greenville County Rec Department, and they have just fees for those kind of things. And that goes back into the operations. Great jobs. All of this is largely distinguished between, and largely probably the number one factor is the financial model. The number two factor would be the ownership model. Privately held, owners. Privately operated, but not owners, just controlled. And public businesses are owned and operated by the government. Who owns the government? Nobody does. So try to figure that one out. Any questions? Have a great day. Study your notes, or this next test will hit us before you know it.